Hi, everyone. I'm Rick Bensignor. Today is Tuesday, May 17th, and welcome to this week's In the Know Trader Show. What do we have on tap? Well, in our trader education portion, we're going to talk about how important it is to do your own work and to reduce your reliance on the media and what they provide for you in your overall investment process. In our sector overview, we're going to focus on consumer discretionary this week. We haven't looked into that sector for a while. Obviously, it's gotten slammed this year. And so we'll look at the chart of both XLY and then the relative performance of XLY against the S&P. And that keeps diving. And we'll take a look at as many of these names as we can here, starting off with Amazon, the highest weighted name in the group. Followed by Tesla, etc. And we'll see how much time we have to get to as many of these as we can. Before we get things going, let me remind you about some of the products that we have here at In the Know Trader. That's the firm I started a few years back in order to give individual investors access to models that generally institutions only have access to. And of course, my 40 years of know-how in this business. So we have two reports. One's a weekly ETF tactical trader report, generally comes out Thursday evenings and gives you a good broad overview of what's going on in the markets. We look into the bond market, credit spreads, the dollar, gold, the S&P, etc. So you get a very good backdrop of what's going on. Plus, I'll give you a brand new ETF trading idea each week and walk you through every open position we have from prior week's recommendations until we close them out. The other is the monthly 7-Eleven Spider Sector ETF report. That report is intended to, it is benchmarked to the S&P. The goal is to outperform the S&P. This is just like anybody else in the money management industry, most mutual funds, anybody who's got a benchmark to the S&P. But what we do here, this is unique and has been incredibly profitable for those of you who have already subscribed to this. It continues to do so on an ongoing basis. We put you in no more than 7 of the 11 Spider macro ETFs. So for instance, XLE, XLK, XLF, etc. There are 11 of these Spider macro ETFs that combined, if you were to apportion in the proper percentage that they represent in the S&P 500, would give you the return of the S&P. Essentially the same thing as being long a Spider. But by being in the sectors themselves, we get to allocate which sectors we want and which ones we don't. And by being in a maximum of 7, it guarantees that you will not be in 4 of the 11 per month. Therefore, with the goal of outperforming the market by not being in those sectors that we believe will underperform. And to give you a sense of how well we are doing and how we are blowing the money management industry away with this product, not including the fact that in May alone through last Friday, we are outperforming by 109 basis points just in the month of May. In 2022, we're outperforming by 1.88%, not including the 109 bips that we're outperforming by this month, not including, going to our fiscal year 2.75%, not including what we've done in May, and 610 basis points since we started this in August of 2020, add another percent onto that. We are blowing away the market. This, and I'll tell you from experience and fact, the statistic is approximately 1 out of 7 people can beat the S&P in any year. That's an amazing statistic. And over time, over 10 years, it's even well less than that. So we don't have a 10-year track record, but we're approaching 2 years at the end of July, and we're blowing away the market by combining the best of the technical models I have with the output from the single best quantitative model I know of in my 40 years on the street. And we look at what the outputs are between the two models. We pick the sectors that the models agree on. We also don't pick the sectors that the model agrees should not be in. And we tweak a little bit here, a little bit there. Generally at the beginning, every first of the month, you have a fresh new report to go into to make your allocations for the current month. And only in April, for the first time ever, did I do a mid-month update. And that mid-month update actually ended up being a very smart thing to do, because it got us to allocate and take a loss away to another outperforming month. So every month this year we've outperformed, and you see the statistics here. So those are our two products. We hope you subscribe, and if you are in spiders yourselves, ask yourself why you're in spiders when you can outperform the spiders without taking on more risk, more volatility, etc. So that's that. Let's take a look at what the macro sector picture is, and this is just month to date, right? So this is May 1st on. This is relative to the S&P. So energy, again, kind of cleaning up against the market itself, outperforming the S&P by over 13% this month alone. The two big losers, consumer discretionary and real estate. And then you can see that it's been a very defensive market, whereby staples, healthcare, and utilities have been the best performing sectors, along with communication services, of which that's a recent bounce on Facebook and who else is in there? Google. Those are the two top. I think they represent about 40% of the XLC. All comes from those two names. So we're properly allocated the way we anticipate things are working, and I'll just lean you towards looking into that 7-Eleven report. All right, let's talk about what we said would be our topic of the week, which is do your own work. Do not rely on the media to heavily sway you in what to do in the market. You have to understand there's whether it's a TV business show you watch, so let's call that CNBC, Bloomberg, or Fox. Those are the three big ones out there, as well as all the information you read. But let's kind of focus on the broadcast media. They're in business to sell commercial time. That's the only reason they're in business, right? To make money. It may seem like they're there to inform you, to keep the public aware, yada, yada, yada. None of that matters, because these are all businesses, and the way they make their money is by selling ad time. In order to sell ad time and get the most they can, it depends upon the viewers, right? So the viewership at any given time will create the cost structure for what it costs an advertiser to put an advertisement into that time slot. So despite the fact that it may seem like they're in business to help you, they're in business to help themselves and their shareholders. And thinking about that also leads you towards why they say some of the things they do, why they try to make shows more controversial or enticing versus then simply a boring show. They're always trying to get stuff to get more people to come and watch. The question I pose to you is, how much good is the information you're getting from these shows due to your bottom line in the market? How much clarity do you get? Virtually for every bull out there, you'll find a bear. Nowadays, certainly for every bear, you're going to find some bulls, but you're going to find a lot more bears right now than bulls. And the bears have been correct. But are the people you listen to consistently getting you the information you want? And is the, let's call it the TV show you're watching, consistently give you the information you want? Does it help? As compared to you doing your own work, meaning that you do your research, get your factual research down way before you start asking for opinions from people. Do your own work and see what's out there. And most importantly, don't fall into the confirmation bias slot, meaning don't, now that you've come up with the work you do, don't only listen to those who support your theory. The smartest investors are going to be people who understand and think about, before they ever put on a trade, why they might be wrong. It's not collecting all the data that supports what they're thinking, because it's easy to find data to support what you're thinking. It's easy to turn on a TV show and kind of just listen to those who support your thesis and disregard those who don't. The smartest investors want to listen to those who don't agree, because there's a reason they don't agree, and what are they seeing that you're potentially not. So here's something I saw yesterday that I thought was kind of interesting. And this was a headline on Bloomberg.com, and a story: shaky stocks send the S&P 500 to the bear market brink and back. Now, this is assuming an assumption that nobody should make, which is that a bear market only exists when and if the underlying moves 20% from a high, or, well, in this case, a bear market sells off 20% from the high. Who said so? So if you've sold off 19.5%, you tell me that you're not in a bear market? If you look at, here's the S&P basic bar chart going back to the COVID low in 2020. Look at what's happened basically from January 1st this year, which is right up in here where my arrow is, right? The peak. You telling me this does not represent bearish price action, that you have not been in a bear market, and that you're going to wait for it to be a 20% move down from the high before you say this has been a bearish market? How foolish. And I'm really surprised that Bloomberg would put this out. I actually know who wrote this article, respect her tremendously. She and I have talked for 5, 8 years, something like that. She often quotes me. This is the type of thing I find interesting, and why you don't want to be fooled into simply listening to the media, in this case, print media, that the S&P has not been in a bear market. We've been telling you since mid-January that the game changed, and you want to think of this at minimum as a two-sided market, taking away what had been purely buy the dip into a buy the dip and sell rally type mode. What, are you going to wait until a bear market is called officially a bear market by people in the media before you decide to sell anything? So look, do your work. And if you do your work and then listen to both sides of the story in the media, from print media, from broadcast media, however else you're getting your information, then you should have a broad sense of what to do in the market. But it should be most heavily weighted upon what you think you should do, not what some talking head on TV tells you. And if you question, who are the talking heads, turn on any of these TV stations and see how many guests they have and how many people try to convince you that they are right and everybody else is wrong. And we've noted before, there are two very prominent bulls who have been bullish the entire year. These strategists are on these channels at least 2 to 3 times a week. And it is incredible to me that they still have the airtime they do, because if you're a strategist and you're paid to be a strategist, and you miss a 30% down move in the NASDAQ and a 20% down move in the S&P, and you have sold nothing this year because your targets are higher and you think we're going to have a great year, I don't care if the market comes back from where it is now and we turn around and make new all-time highs. You have not done a service to your clients in that respect. So don't just listen to people who you want to listen to because it matches what you think. I've done videos for StockCharts in the last month to month and a half about how to play the market when the VIX is at 30, about why you should be scaling in and scaling out of your trades instead of picking one and only one point to play, about selling into rallies as well as buying dips, but that the game had changed and it was no longer simply buy the dip. And I'm just one person you might listen to, but I try to present the balanced and fair point of way of thinking about the market such that you don't fall into a single trap of that the market only moves up or the market only moves down. And there are periods that it does that. But look at the S&P now, which moves 2 to 3% off in a day. If historically an entire year has an approximate 8% gain over time, right? We know the annual return of the S&P is approximately 8% historically. If you're doing 2 to 3% in a day with some frequency, you're moving, in theory, months worth of price action in a single session. If you get too hell-bent on your theory being right, it can cost you a fortune. And those who have done no selling at all, nothing defensive at all this year, if you're a, let's say you consider yourself an investor, not a trader. So the bulk of what you do is buy and hold because you've picked the companies or the ETFs that you think over time are going to do you well. When you get into an environment like we've been in 2022, there is no reason you can't either lighten on those positions. If you don't want to do that and you know how to use the options market, then why not sell covered calls? Do something that doesn't leave you totally exposed on the long side. And I've seen people on Facebook and these videos and people saying, you know, we're long-term investors and I don't care that the markets come off 30%. That's total BS that they don't care the markets come off 30%. They're just covering their rear ends because they didn't tell you to sell anything this year. So I want to move on to getting into our look into the consumer discretionary sector. But the bottom line here is do your homework and reduce how much of the total input you take from talking heads on TV. That's today's lesson. All right, let's move to charts. First chart, XLY, consumer discretionary. Pure bar chart, this is a weekly chart. How important is where we're currently trading? It's very important. Price right now in real time, 150 and change. Look at the lagging line against the bottom of the cloud. Last week in real time, when we were making the lows, that blue line was down here. It had broken through the bottom of its cloud, quite negative. By the time it closed on the week, it actually held on, and here we are a little bit down on the week. And again, it is playing, what's this level? 150.69. I'm not going to worry about pennies here. If on Friday we close at 150.60 and we've closed 9 cents beneath the bottom of the cloud, is that a definitive break? No. But if we close enough that it's more than pennies, but let's say we closed at, 148.5, I'm just picking a number, and we clearly have come through here, then I've got to assume that there's still a decent chance that this is going to come down and hit its propulsion level down at what is that, 138 and change that were not done. That this setup count that's only on bar 6 probably can still reach a bar 9 count. We know that setup 9 counts often means something, especially on a weekly decline in the market. They don't come often. So I can't tell you which way to play this now, other than the fact that I'm going to pay a heck of a lot of attention to where we close this week. And if we hold on here or not, we know that subsequent closes beneath that the line goes flat for the next several weeks. So 150, 104 starting next week. The more closes we have beneath this, the greater the chance that we're still not quite done. Let's look at XLY versus the S&P. This is a monthly chart. This is all-time price history going back to the late 1990s. Excuse me. The long-term outperformance, certainly there are periods, even years, where consumer discretionary underperforms. Look at what we've seen since the beginning of this year. Massive break, the sharpest decline we've seen. And price is currently underneath the cloud. What's important now is the lagging line, which is the blue colored line, which you'll notice is an exact mimic of the price. This is a bar chart, so you have the exact mimic. It is current price pushed back 26 bars. It is at the top of its cloud. The bottom of the cloud for this month is 0.383 and change. I'm sorry, 0.363 and change. If we break through here in coming months, there is support here. And if you want to be a counter trend trader, then you could play for a bounce against this zone. It did that. Actually, no. Here we bottomed against the bottom of the cloud. This would have been, so look, back in late 07, 08, 09, the lagging line played and had one little close beneath before we turned around and one higher. So in the next couple months here, as we go into the summer, it's going to be really important to see whether or not this holds or not. Another significant move down means we're likely heading to the 200-week moving average of relative performance, if not a long-term uptrend line, which is a little beneath there. So consumer discretionary really is on a tough place to call right now, other than we know there's some support both on the outright chart and relative to the S&P here. But even if I put on, let's say, the sequential model, we're only on bar 5 here, a 5 towards a 9 count. There's no buy. If we were on bar 8 or 9, maybe I'd say I'll take my chance and I'll come and buy this, but we're not. And therefore, it's too soon to call the bottom with any sense of, let's say, with a high confidence. It may bounce here because there is support, but I'm not going out with the call as of yet that this is the time and place to come back to buy consumer discretionary. I could see a bounce, we could rally very quickly back up to the bottom of the cloud next month, but if we come back down again, as the summer progresses, it's gonna open the door for a breach. And as we go forward several months, you'll notice that the bottom of the cloud moves up, such that, I don't know, probably a half a year from now, if not a little less than that, the bottom of the cloud is much higher. It's virtually where we are now. So we know that in the future, if we took out these levels that we're at now, it's gone for a bigger move down. And then you have the whole cloud on top of you in the future as potential resistance. So you would have changed the long-term picture of consumer discretionary. And that's not a good thing, because in typical bull markets, consumer discretionary usually is a leader. You want the public going out there and buying discretionary items. It shows confidence in the economy. And we're clearly not seeing confidence in the economy since, and we're approaching a pretty pivotal point. Now, I have talked long-winded enough as I have my timer on to see that we're not going to have time to get to the names, because I could get to one or two very quickly in the minute we have left, but it doesn't pay. So what I'm going to say is next week, we'll come back and focus on this sector again. We'll keep the comments much shorter in the educational portion. And then we'll do a deep dive into XLY plus those 15 or 20 names, and we'll make the bulk of the show going through the names so that you have an update on a sector that potentially presents an opportunity now, or we'll look at what doesn't present an opportunity and it is still too early to buy. So that's it for this week. I hope you take to heart what I talk about when I say do your work and pay less attention to what you read and hear on TV. And that's it. I'm Rick Bensignor. Oops, sorry. And thanks for listening to this week's In the Know Trader Show.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.